started, and so we can start. Mike, if you want to start recording, that would be cool. So it's really a pleasure to welcome Shoshana Vasserman from Stanford Graduate School of Business, where she is an assistant professor, having joined the faculty last year, 2020. The work that she's going to be talking about today, the paper is available on her website, is just really a great example of the contribution that economists and economics can make to the study of insurance regulation. The advent of telematics and consumer monitoring has generated a lot of controversy in this world. And it's mostly been controversy without either the data or the econometric tools to go beyond speculation about what might happen to try and understand what is actually happening. And the problems are actually even worse than most people appreciate. They're just, by worse, I mean more complicated and more intricate, because a full analysis really has to encompass not just the uses of telematic information by insurers, but the decisions to provide such information by the consumers and the reactions of rivals and all that. So to sort of just keep track of all the moving parts and sort them out and put them in some kind of consistent framework is really a very difficult task. But fortunately, Professor Vasserman has the technical chops to do this, as well as the obvious ability to explain it all very lucidly. And really, today's paper was the kind of the motivation for me to start this whole series of this, and thought, wow, this is something that people really need to know about that no one has talked to the insurance world about. So it's really a pleasure for me to welcome her here today, and I'm really excited to have her coming. So thank you very much, and the floor is yours. In terms of questions, I'm going to keep the queue, and Shoshana will wait till near the end, and then when she's ready, we'll start calling on people. Thank you. Welcome.
Awesome. Thank you so much for the wonderful introduction, and thank you for having me. I'm honored to have helped inspire this great series. Okay, so I'll be telling you about a joint project. This is with my colleague Ijo, who is on the academic job market at the moment. He's a postdoc at UC Berkeley, but will be a professor very soon. This paper came against the backdrop of new technologies emerging in general that open new possibilities to have transactions that involve consumer data. Now, consumer data can be useful to both consumers and to firms. Being able to allowing consumers to show firms what they do with their products makes it a lot easier for the firms to customize their products to suit individuals a lot better. But it also increases the ability for firms to contract directly or to create direct monetary or otherwise conditions to regulate what otherwise or previously would have been private behavior, and especially when that private behavior is costly in some sense, what we in economics would call moral hazard. I'll say more about that in a little bit. But an important part of this whole process is that as soon as you allow for contractability, of course, you have a lot of concerns about privacy that is around the private behavior. And the way that the marketplace has dealt with these issues thus far, for the most part, is to make sure that the firms can't coerce their consumers to give their data by fiat. Rather, they have to somehow incentivize consumers to voluntarily share that information. And then the flip side is that if they provide those incentives, then typically the firms will own the data that they collect from consumers as proprietary, and they won't have to share that with their competitors. The particular setting that we're going to study here is auto insurance. And it's a program similar to one that all of you might have interacted with. Many companies have had similar programs. The general idea is that rather than just getting a quote that you're stuck with based on what the insurance company can surmise from your survey, an auto insurance company can give you the option to opt into some sort of monitoring program where you stick, at least when we were in the data sample that we were studying, you would get this plastic device in the mail, you would stick it in your car, and it would essentially track how you drive, send that information back to the insurance company, and the idea is that you would get some sort of discount, at least hopefully, for showing the company that you drive better than the company would have otherwise predicted. Of course, currently, a lot of these programs are moving to mobile phones, but the same idea is going to apply. And of course, this isn't just a program that's specific to auto insurance. There are lots of ideas floating around all over the marketplace. From I think life insurance with step counters and gym memberships, all the way to Uber's various attempts to get us all to sign up for their Visa card and show them what we spend our money on. But there are a lot of moving parts here, both in terms of who stands to benefit and who stands to pay. It's pretty easy if you listen to the insurers talking about these kinds of programs. One of the types of incentives that they typically talk about, one of the main reasons that they talk about wanting to do this, is that having a monitoring program would allow them to, quote unquote, combat information problems. So for example, if you are a young man coming to get auto insurance, you will get the worst possible rate imaginable because auto insurance companies expect you to be a terrible driver. But if they were able to be convinced in a credible way that you are in fact a good driver, then everyone would stand to benefit. But now, of course, if only one auto insurance company knows that you are a good driver despite being a young man, then they also have a competitive advantage because their competitors don't know, at least not in as credible a way, that you are as good as you say you are. Because they have a competitive advantage, perhaps they have the ability to extract some of this surplus from you. Perhaps if all of the companies knew just how good you were, you would get a lower rate, but they don't have to give you that competitive rate right away. And so there are lots of ways in which insurers can benefit and profit from the possibility of monitoring. But of course, they still can't coerce consumers to monitor their behavior. They can't by law. And so the question is, how much does the requirement that consumers have to agree to share their data limit the insurance companies' ability to extract rents? And conversely, what is the welfare benefit to consumers? Certainly, you still benefit from getting a lower rate as a good driver, but what happens if you're a bad driver? What happens relative to all the possible other counterfactuals that you might imagine? And so there are lots of moving parts, and so to study them, we focus on a very particular case. We're going to have data from a major US auto insurer. I can't tell you which one, but it is one of the largest ones on the marketplace. During our research window, which lasts about 4 years, the monitoring program was introduced, meaning there was a period of time during which there wasn't a monitoring program. But there's lots of variation throughout the time, and we get to see as much as really you might expect to be able to. We get to see the quotes that represent what options, what alternatives consumers who wound up choosing to get insurance with our insurer would have seen and would have been able to compare. We see the claims for any accidents that happened during the research window. We get to see all the discounts that were offered and delivered. And of course, the monitoring outcome for people who decided to participate in the monitoring program. I mentioned the quotes already, so we get the quotes that the insurance company gave, but we also match them to a menu of options that would have been available based on regulatory filings. I'll take a few questions. I know that I just said a lot, but I'll come back for questions a little later. Let me tell you a little bit more about the strategy for what I'm trying to do here first. So there are two major questions that we want to answer. We want to understand the welfare and profit effects of monitoring. And so the first question, if we're going to do that, is to ask, how useful is monitoring? What effect does monitoring have on drivers' behavior and on insurance consumers' behavior? And second, how much information is revealed in equilibrium? If the whole point of monitoring is to allow the consumer to discern between better drivers in an unobservable way, then how much of that actually happens in equilibrium, and what information spillovers might there be? To do this, we take a few different kinds of approaches. First, we take what we would call a reduced form approach, and we provide some fairly simple statistical evidence for what monitoring actually does, in both demonstrating better risk rating, but also we will show that it incentivizes safer driving. That is to say, does monitoring have an effect other than providing information? We show that the answer is yes, and we quantify it to what degree that's true. The second question is a bit harder, and so we have to build a model that explains how people choose which insurance plan they decide to take up, and more importantly, whether they take up monitoring given the incentive structure that they're provided with, given the discounts that are made available to them and what they expect to happen once they enter monitoring. We combine that with the information that the firm learns as a function of this. If the firm provides greater discounts, that incentivizes more people to opt in, and so in principle, the firm should learn more information. So we characterize that process. And the reason we do all of this is because we want to see what would happen in a world without monitoring, and maybe in a couple of other things. So just to jump in, so the high level picture of what we're going for is, in the first case, we want to know to what degree does IT have an influence in this market? What does it do to information problems? What does it do for moral hazard? And in the second case, we want to know, what do privacy standards mean here? What does the fact that the firm has to incentivize consumers mean for the amount of information that's revealed? And how would the world look like if there was no monitoring available? Let's say if the regulators shut down the possibility to do monitoring at all, or conversely, if the data couldn't be proprietary, so that whatever the firm learned through the monitoring program, it had to share with its competitors. So those are the two counterfactual questions that we'll answer. If there are any brief questions, I'll pause now before I jump in.
Doesn't look like it.
Okay, great. Okay. So you are all likely familiar with insurance in general, but let me tell you a little bit about how auto insurance works. So the basic premise is that auto insurance is typically composed of periods that last 6 months. And so here's the timeline of the first period of an interaction that a consumer might have. At the beginning of the interaction, a consumer would have a menu of options of different coverage levels, and it would make some sort of choice. So let's say they would get some liability limit, and that would come with a premium and a deductible amount. The consumer then proceeds to be insured. At month 5, they would get a renewal offer, and then they would have to decide whether or not they want to stick with the insurance company for an additional period, or if they want to leave, and that's the attrition choice. In between month 0 and month 5, lots of things can happen. In particular, what might happen is that the consumer might have some sort of accident, and if that's the case, they would file a claim and pay the out-of-pocket cost. So the out-of-pocket cost would depend on their limit, and it would depend on the particular plan that they chose, the particular reimbursement rate and the coverage level. That claim gets filed. And of course, not only does the consumer pay the out-of-pocket, but then the information also gets filed into the actuarial model for the renewal offer, and the claim would typically produce a surcharge. That is to say, the renewal rate would increase. To give you a bit of a sense of what our data actually has. So we're looking at an auto insurer that's available in most states in the US. And to make things really simple, we're going to focus only on people who have one driver and one vehicle insured. So we're never going to see husband and wife pairs in the same car. We're never going to see people who can split their driving across different cars, which would make it a little bit more difficult to figure out what risk looks like. So we're going to focus on one driver, one car customers across 22 states in 4 years. That induces lots and lots of variation. The quote will typically have lots of different components, but we're going to focus on liability, since liability is typically the thing that is the biggest component of mandatory minimums. So the way this looks for consumers is that typically you will see some sort of choice of discrete options, somewhere between 30K and 500K. And there will be different mandatory minimums depending on which state you're in. There are many competitors, and the number of major competitors really varies by state, but in general, we're going to look at the top 5. And so across all our data, across the 22 states, the average coverage choice is about $74,000, and slightly less than half of everybody that we see chooses the mandatory minimum. So they just choose the smallest coverage amount they are required to take by law. There's also lots of variation in the premium, but on average, you might think of the premium as something around $380 per 6 months. That's the average. Accidents are very rare, luckily. And so across our data, on average, there's about 1 claim per 10 years that costs about $6,000. That's very rare. And whenever there's a claim, there's pretty much always a renewal quote change. We observe the renewal quote change whether or not there is a claim. So even if there isn't a claim, your quote might change, for example, because the company would like to give you a bigger discount, or sometimes there's a surcharge just based on changes in the general risk pool. And we see people throughout their interactions with the company from the first period onwards, and so we see whether they leave at some point. Um, we're going to focus on, in our particular setting, the monitoring program only applies to the first period. And so as soon as you engage for the first time with the company, at the point at which you're making your coverage choice, you also get the option to opt into this monitoring program. So you'd be offered some sort of opt-in discount, so a multiplicative discount on your premium, say something like 5%. And then you would be monitored for months 0 to 5 up until your renewal offer. At that point, you would get a discount or a surcharge that you would be told something about initially, but wouldn't be calculated until the end of your monitoring period. And so what monitoring means is that you have this thing in your car. The company takes care to make sure that the device is actually connected, and so they'd be aware of strange behavior. But the general requirement is that they observe something around 60 days of driving behavior. And the device is basically an accelerometer. And so the kinds of data points that it tracks are mileage, so they'll see how much you drive, the extent to which you brake in a really harsh manner, the extent to which you speed or accelerate and decelerate very fast, and the time of day during which you drive. So some of these features you might think would correlate with accidents, and you're told about this from the get-go. An important feature of monitoring is that although you are monitored only for the first period, so you only have to keep this device in your car for 5 or 6 months, after which you're asked to send it back, you get a discount. So let's say you get something like a 10% discount, and then you keep it forever. So even if you stay with the company for 3 years and your premium changes across time for whatever reasons, just because you're getting older and things are happening, the initial discount, the multiplicative discount that you get, the 5 or 10%, will stick with you forever. And as I mentioned, people know what is being monitored, and so there's a website that you can go and track. They would give you kind of like a heuristic score of how well you're doing. They'll also give you more concrete feedback sometimes about good and bad things that you've done in terms of driving safely. The idea is to try to teach you to drive more safely. And so at the end of the 5 months, you would get a score. The score basically tracks the extent to which you outperform the company's expectations for you. So if you were a young man, the expectations were very low. And so if you drive kind of well, you would outperform the expectations and you would get a lower, better score. And a discount that is consistent with the filing. So this is all verified by the regulator that applies directly to your plan. And so here's a sense of the distribution of the monitoring scores. You should not think at all about what the numbers on the x-axis mean. These are all normalized to something. But the general idea is that lower scores are better. And the distribution is fairly log normal. So these are log monitoring scores. In general, there's variation across states, but in general, we see something like 10 to 20% opt-in from all consumers across states and time. And this basically doesn't change. Okay. Any questions before I move on?
We did have one question from Tom Magnuson. Tom, did you want to ask?
Sure. You said that the discount for the monitoring program applies, in perpetuity until, such time that you prove that you're not a good driver. But how would insurers combat unrepresentative data, such as, if I did the monitoring program now during COVID times, I don't drive that much, but then as soon as I assume things will ease up in terms of travel restrictions, I'll be driving a lot more.
Yeah, so our data does not include COVID times, and COVID would definitely be a challenge. I don't actually know how they're dealing with it.
I guess you could extrapolate that to job changes too. Like I changed jobs. I was in New York City, and then I came out here, for instance.
Right. So there are a few ways for people to challenge their scores. Most challenges get denied. Most of the time, it's like people saying, I braked really hard, but that was the right thing to do, and the company doesn't have much to say about that. I think for major changes, like a job change, you might be able to request to do this again or something like that. Like I think that would be handled on a one-to-one basis. But I mean, this is sort of up to consumer, and the company's incentive, the company's motivation is to try to get as representative an image as possible. And so we typically think of it as going the other way, where the consumer tries to trick the company into thinking they don't drive as much. In general, we tend to think that not using your car is something that's pretty hard to fake. And so we're not too worried about it, and the company is certainly monitoring it. So for example, if you don't use your car at all, they would follow up.
Okay, thanks.
Can I just ask quickly? So your chart made it seem as if that there was a crash, something that generated a claim, that it went automatically to a claim. But does it matter to your data whether people have the choice of reporting the claims or not? And many people don't. They just pay out of pocket completely without ever telling the insurance company. Presumably the monitor does not detect that. Like they can't tell whether you were in a crash or not.
It absolutely does matter. So censored data in insurance claims is a very well-known problem, and so I won't talk very much about it. But when we go to estimate risk models with claims, we very much take into account the fact that that it's unlikely that we will get many claims that are below the out-of-pocket cost, for example. We're not going to capture it perfectly, but I think we do pretty well, at least as well as the actuarial people would do.
Great.
Okay. I see a few more questions. Let me move on a little bit, and then we'll come back to them. If that's okay. Okay. So the first question that I posed is monitoring useful? And I'd like to convince you that even from just looking at claims data and scores data, it looks like monitoring does have a pretty sizable effect. And there are two ways in which we see this. One is that we see a direct change in consumer behavior. Drivers seem to become about 30% safer when they're monitored. And that kind of makes sense, right? All you have to do is behave well for 6 months, and then you get a discount that you get to keep for life. Now, of course, there are lots of things that could be going on. It could be that you're trying to maximize your discount forever. It might just be the idea that you know that somebody's watching you. We can't really differentiate those two things. But if we compare the driving behavior, the claim realizations for drivers who opted into monitoring during the monitoring period and afterwards, and we compare that relationship to the claim realizations of people who didn't opt in, we see a clear difference. And so let me show you a little bit what that looks like. So here is a progression of average claims in a balanced panel that looks at the difference between the average claim count. And here we across different periods. So each one of these periods, 0 through 5, is 6 months. So this is 3 years of data. And here in the gray, I'm showing you the average for groups of drivers who did not opt in. So as you can see, there's a bit of fluctuation, but it's generally all across around 0. Now, if we compare this to drivers who did opt in, let's focus on the right side from period 1 onwards. First of all, we see that the trends look very similar. But the drivers who opted in are just a little bit better. Their claim count is a little bit lower in every period than the drivers who didn't opt in. So what that tells us is that there's some sort of selection effect. The drivers who opt in are different than the people who didn't opt in. And we don't know necessarily where that came from. Just from looking at this chart, we don't know if that would have always been the case or that was the case because of the monitoring program. But what we can see very, very clearly is that if we compare period 0, this is the monitored period, against the periods 1 afterwards, there's a clear difference. And if we compare the average claim difference in period 0 against what it would have been just given this trend line, that we would find that that drivers who opt in are about 30%. There's a 30% difference just in period 1. And of course, this doesn't last afterwards. It's just for the first period. So what this means to me is that the monitoring program itself seems to be doing something that doesn't last once monitoring is over, even if there is something that does last. The second result, however, is that although it seems like monitoring is doing something in and of itself, it's also providing information. And when we talk to insurance companies, this is what we heard a lot. One of the main reasons that insurance companies want to have monitoring programs is that it allows them to find the people who can't credibly convey that they're good drivers, even without the monitoring program. That is to say, even if monitoring didn't have any effect on their behavior, a driver who opts into monitoring program would presumably do so because he knows that he's better and he wants to convince the company that he is better. This is what we would call selection. And so we can test to see if this is true by checking if the monitoring score itself is predictive of period claims, even though we know that there's a difference between the monitoring period and the other periods. And what we find when we do this fairly simple regression is that having a score that's a standard deviation higher than the mean, higher than the average score within across people who are monitored, corresponds to a 29% higher claim count in subsequent periods. Which is to say that the score that the company, the score that a person gets is going to be pretty informative of their subsequent behavior, even if they're never monitored ever again. Okay, maybe now's another good time to pause for questions.
Great. So let's see. Do I see any hands up? I don't. Looking at the list, so you can just go ahead.
All right. Okay.
I did have one question. I'm sorry.
Yeah.
So if your score shows that you have, in fact, substandard below what the other criteria would demonstrate, does that also, stay with you for a lifetime, so to speak?
Yeah, I think you're saying I've talked almost entirely about discounts. You're saying, is it possible that you would get surcharged in some cases?
Right.
And the answer is yes, you can get a surcharge, and yes, it would stick with you forever. Now, you might imagine that a person who has a surcharge has less of an incentive to stick with the company. And so observing attrition information is going to be important, but yes, in both counts.
Thank you.
Okay. So what I've shown you so far hasn't taken any sort of demand directly into account. This is just looking at claims and opt-in decisions. But what we want to know is what happens in equilibrium. We want to know what would happen if the monitoring program didn't exist. How would driving look? And to do this, we need to do something slightly more involved. Now, I'm not going to go through all of the game theory and the math, but I want to give you a gist of how I'm thinking about this at a pretty high level. So the general thing that I'm trying to do here is I'm trying to understand how a policy, in this case, the status quo policy, which involves the existence of a monitoring program with the particular choices that the company made for surcharges, discounts, renewal rates, etc., how it results in plan choices. And of course, plan choices then result in claims and whatnot. And I'm going to think of a plan choice as the combination of the coverage level, the deductible, and whether or not people opt into a particular program. So I have some sort of policy, a status quo policy in mind, and I want to understand this mapping. The reason I want to understand this mapping is because I want to change the policy. I want to keep the plan menu the same, or maybe change it a little bit, but keep the same driver, the same population of drivers. And all I want to do is to tweak what is available in the menu. And so how am I going to do this? Well, what I'm going to do is I'm going to try to develop an econometric model that maps, that builds in a mapping from my population of drivers, which I can think of as a combination of driver characteristics, the distribution of types of people that are involved, that might consider buying auto insurance. And I want to build a model that explains how these driver characteristics map onto the particular plan choices that we see, the particular plans that people bought, the resulting claims that they had, as a function of what they did. For example, if they opted into monitoring, then their claims records are slightly different, and all of the different accounting features that are involved, the renewal rates that they were offered, whether or not they stayed with the company, the particular claims that they did and didn't file, etc. And so what my econometric model is going to do is it's going to try to map this out as finely as possible, so that when I want to run a counterfactual, all I need to do is tweak my econometric model. I need to tweak the options in my plan, and then everything else is going to adjust accordingly. Now, in order to be able to do this kind of procedure, I need really, really rich variation. I need to be able to see a lot of different combinations of possibilities of different menu options that were available and resulting outcomes. And we have that in this data. We have 22 states worth of data across 4 years. And within this data, we have a lot of variation in the prices that vary by the particular zip codes and time, depending on the kinds of people who are involved in the regulatory hurdles that pertained to the particular place. There's of course seasonality. People drive more in some parts of the year and some parts of the country than others, and they're more likely to crash during some times of the year than others. We get to observe all of these things, and they're going to allow us to tease out some of the mechanisms that drive the outcomes that we see. There's also a variation in monitoring eligibility over time and across space, and so we get to see differences in how the particular people who are able to opt into monitoring might face different variations of menu options. So slightly different discounts that they're offered, slightly different renewal rates that they're offered, etc. And we have a lot of variation just to test on. So for example, in two of the states in our study, the mandatory minimum changed. And so we can even do a cross-validation exercise in which we see how well can we predict how people would change the plan choices that they make if the mandatory minimum changes. Okay, a little bit more specifically, our model is going to have two types of different components. The first component is something closer to an actuarial model. It's going to be a model of risk. So this is going to be trying to explain the claim counts that we see jointly with their severity, as well as the monitoring score and the extent to which monitoring reduces risk for people who opt into the program. I'm not going to go into the details of how I construct this, but I'm very happy to talk about it in detail afterwards if you're interested. And of course, all of this is laid out exactly in the paper. But you should think of these as a statistical model. Given your observable characteristics, given your plan choice, and the out-of-pocket costs, for example, that are involved, we build a statistical model that will will predict your probability of getting a claim jointly with the distribution of the severity in dollars of that claim, as well as the score that you got if you were that you would have gotten if you were in monitoring, and how your risk would have changed if you were in monitoring, if you were not. This is one set of parameters, or one half of the model. The second half of the model looks at demand more directly, and these are and it's going to consist of a couple of different components that are common in insurance and looking at insurance. The first type of parameter is going to be risk aversion. So the idea of risk aversion is really the premise of insurance. The idea that the reason that we have insurance is because we are not indifferent between a 50-50 lottery or a 20-80 lottery. We would be willing to pay a premium every month to know that that our exposure to large shocks is minimized. That if we were to be in an accident and be liable for a large amount of money, we wouldn't have to pay it. So the extent to which we're willing to we want to insure ourselves, the extent to which we're willing to pay a larger amount upfront to have a lower tail risk down the line is going to be measured by what we would typically call a risk aversion parameter. And so if I'm more risk averse, I'm willing to pay more upfront to avoid larger shocks later, and vice versa. The second type of parameter is what we would call a switching cost, or sometimes called inertia. This is the idea that people like that having to change what you're doing is kind of a costly thing. And so if you have an insurance plan right now, even if it's not the best insurance plan for you in some sort of objective way, you might still stick with it and not shop around to get something better, just because that requires a lot of energy and has an emotional or maybe a tangible cost. The third kind of parameter that we're going to look at has not really been looked at in the literature before, but we think it's very important. This is the idea, this is what we're going to call monitoring disutility, and it's pretty similar to this inertia idea. What this is going to capture is the idea that people might not opt into monitoring for many reasons. In principle, you should opt into monitoring if you believe that it will give you a discount, if you know that you're a better driver than you're getting priced at. But if even if you're a very good driver, but you just really don't like the idea of being tracked, you might still not opt in. And the parameter that's going to explain why you don't opt in is going to be the monitoring disutility term. And so without writing down the model, let me give you a sense of why we can identify some of these parameters, all of these parameters rather, in the data. I'm not going to spend very much time on the risk parameters just because this is a pretty standard thing. Like this is what insurance companies do, and I think we do something quite similar to them, or at least quite similar to the academic counterparts, to their academic counterparts. What I do want to focus a little bit more on is the demand parameters, because that's really the IO economist part. So the idea of mapping out risk preferences is not new. I think the first time that I saw this was in a paper by Alma Cohen and Liran Einav, looking at a different type of auto insurance in Israel. And the idea there is that you can try to map out the risk preference or the extent of people's risk aversion by looking at how they made choices across different options of risk coverage. So if they had the option to choose a plan that had, let's say, a higher premium, lower deductible, and another plan that had a lower premium, higher deductible, the extent to which they choose one over the other is going to determine what, at least at a high level, how risk averse they are. And if you see enough observations of this, if you see enough variations, you can get a pretty precise measure of how risk averse different people are, and more importantly, since we're interested in the population, what the correlation between risk and risk preference and the other characteristics are. So what we want to know, for example, is how risk averse are people who are riskier, are people who have more claims, more likely to choose plans with higher or lower deductibles. This is the kind of exercise that we're trying to do, and we can observe that directly in the data. So this is the gradient of the willingness to pay. How are they choosing between these different plans? To the extent that we can observe inertia, this is really what's going to govern the attrition rate. We know that people can always switch plans. They can always go to other companies. We don't see which companies they go to, but we know what options they would have gotten given their observables. So we can look at the quotes that they would have seen from the top 5 competitors. And so we know when they would have gotten a better price than our company was offering them. To the extent that they get a better price available, or at least they would have gotten a better price that would have been available had they looked, but they didn't, we can infer that they had some switching inertia. They prefer to stay with us even though it was not better. And so this is going to really be governed by the attrition rate. Conversely, if we see people trading all the time, even if they're very good customers, then we know it's something else. Okay, and the last thing I think I already prefaced, we do see lots of people not opting into monitoring, even though we think, based on our statistical model, that they would benefit from it. And so what this suggests to us is that there is there's a significant factor of monitoring this utility. There are many people who just really don't like the idea of being monitored, and we allow this to be heterogeneous across people. But this is where the measurement is coming from. This is going to be explaining the part of the data where people don't opt into monitoring when they should. Okay, so what is our model giving us? What is it producing? So here is a very simple example. So what our model is going to do is let me go back. So what I've just described to you is the econometric model. These parameters are basically this green part, this light green segment that's mapping the outcome data to a prediction, a mapping from driver characteristics. And so what we can do then, once we have our model, is to go in reverse. We have a set of driver characteristics from our data. We then plug in the parameters from our econometric model, and we can look at the outcome data and compare how our predictions map against reality. And so the first kind of prediction that we might look at is how many people opt into monitoring. And so, and what do they look like? So here's the graph that I showed you before. This is the distribution of monitoring scores among people who actually opted in to the monitoring program in our data. These are real people, real scores. In red, I'm plotting the predicted score that our model would have given all of these people. And now, because our model specifies every part of the demand process, we can also predict what would have happened if everyone in our sample, including the people who didn't opt into monitoring, were to participate in monitoring. What score would they have gotten? And what we see if we do this extrapolation is that the people who opted into monitoring are a lot better. So remember that lower scores are better. And as you can see, the orange dashed line here, which is the distribution of monitoring scores predicted monitoring scores among people who didn't opt in, is shifted to the right. So they're all much worse. So this is giving us sort of two things. On the one hand, it's showing us that we're fitting the data pretty well, and it's also confirming what we saw with our reduced form test, that there does seem to be selection. People opt into monitoring because they know that they're better drivers. But we also see, I mentioned that we see a lot of people who seem like they could benefit from monitoring and don't. And we rationalized this by our monitoring disutility parameter that we called XI. Sorry, I didn't introduce this notation. And what we find, even with a lot of heterogeneity, we find that the average disutility term is worth about $93. So people are willing to give up about $93 on average in order to avoid being monitored. And this utility term is higher for people who are younger, less educated, have older cars, and have poor prior insurance. Take that to mean what you will. I won't speculate, but this is what we find. We also find that monitoring this utility is increasing with risk. And so conditional on everything else, it's conditional on the expected discount that people would get. People who are riskier and who have worse driving records also seem to dislike being monitored even more. Or conversely, people who are safer are more likely to opt in, are less likely to mind being monitored, even if they were offered the same exact discounts. A few other points, and then I'll pause. We find the amount of risk aversion that we find on average is not very high. So these are papers that you might not know, but basically the level of risk aversion that we find is pretty similar to that Cohen and Inhofe paper, which looked at auto insurance, and it's smaller than some recent papers on health insurance, for example. One way to interpret that is that people exhibit different levels of risk aversion depending on exactly what gambles that they're taking. But at least within the scope of auto insurance, risk aversion does not seem to be very large, especially given the mandatory minimums that exist. But the last thing that I want to tell you is that in addition to the fairly large monitoring disutility, there's also a fair amount of inertia. We find that the extent to which people don't explore other options would account to about $283 on average. That is to say, people could save, people are foregoing about $283 on average in benefits from switching to other firms, and they choose not to do so. All of which is to say, even in a seemingly very competitive market with lots of different firms, 5 is we typically think of a lot. No one with a dominating market share. Even so, the market is imperfectly competitive, and this is even before we account for monitoring. Okay, let me pause. Any questions?
Okay, Josh Teitelbaum.
Hey, thanks. So I'm enjoying this very much so far. Just a couple of questions or comments. So on the monitoring utility, I was going to ask you about whether it was correlated with, risk aversion from their coverage choice. You seem to say that it is, and it's also correlated with your riskiness. So especially the first result, it leads me to believe that monitoring disutility is not just about, because you also said it's the young, and right, you told us who it is, and it all leads me to think it's not just about that you don't like being watched, that monitoring is a risky choice itself, right? Choosing to be monitored involves risk because you could have a bad draw. It could just be a bad 6 months for you, and you'll end up sending sort of a false signal to the insurer that's going to stick with you.
So we are capturing that in our model, in the sense that we model the uncertainty of what their score will be as a function of how risky you are, and your risk aversion governs everything.
Yeah. Oh, good. So I mean,
Cool.
I mean, to me, it was just a matter of interpretation. You seem to be interpreting it as just some sort of psychic, I don't like to be watched, but it's just another risky choice, just like the amount of coverage, right? Or at least that's one way to interpret it. And
so the monitoring disutility is additive on top of that, and so that's explaining what comes even after you account for the differences in this utility from the uncertainty of being monitored.
Okay, great. And then on switching inertia, so you're interpreting inertia or defining it as failure to switch when you could get a lower price. But of course, right, there can be differences there are other differences that matter other than price, service quality. So, Right.
And we're
So
not able to fully account for that.
you said you're strictly going on.
Yeah,
claim.
I mean,
Yeah.
we that's right. So there are a few limitations to our study. Major limitation is that we only get to see the customers, the drivers that opt into our program to begin with, and then to the extent that we can characterize the characteristics of their competitors, we mainly only see the quotes. It'd be hard to compare, for example, customer service, even though we know that those are important. If we had data from other companies, then we would be able to see, for example, how likely they are to, we would be able to get a measure of sort of mean quality or something like that. But we just can't do that with our data since we don't see any behavior after people leave.
All right, great, thank you.
Yeah, but that's a very good point.
Bernie Birnbaum had a question in the chat, but if you want to ask it, please go ahead.
Thanks. I was wondering, did you review the data on those who selected monitoring or opted into monitoring, whether the data reflected some kind of racial or other bias that might affect your conclusions?
I'm pretty sure that insurance companies aren't allowed to price on racial characteristics, and so we didn't look at that either. So I don't know.
Well, that wasn't my question. I know that they don't price on racial characteristics, but you have the data on the people, you have their geographic location so you can obviously assess whether there's bias in geographic location and racial bias.
Absolutely, and I don't mean to suggest it's not an interesting question. It's just it was outside the scope of this particular exercise, so I can't really comment.
So that would go for sex too, presumably, which is actually in your data. You don't have to impute that. You just don't.
That's right. That is in our data, and we didn't. Yeah.
I can just assure you, as a partial outsider to the insurance regulation world, that's a really hot topic. If you want to write another paper on this, there'd be a huge demand for that. Samantha Ostreicher had a question.
Okay, just one last question because I have a few minutes.
Okay. Yeah, great.
Okay, mine is pretty brief. It's just I was wondering if you were able to kind of the people who did opt in about the time frame of like when they were driving. So whether like were they more heavy on the opting in when they have like 9 to 5 jobs versus people who are in less routine jobs or more of the like third shift late night. Because I think
so we weren't.
That isn't interesting anyway.
No, absolutely. It's an interesting question. So I can't really say much about it because we didn't get this aggregated raw monitoring data. We only got the scores. And so we don't know actually what's underlying it. We only know what sorts of things might have led to a higher or lower score. So we know, for example, that driving late at night is correlated with more accidents, for example. And so I would guess that people who drive late at night because they have jobs that require this would have higher or worse scores. But it's just not something that we saw for this particular project. Okay. Does that okay, good. So going back to the question of what monitoring does, one final way to assess this is to compare a counterfactual world in which monitoring didn't exist. Now our structural model is going to be able to predict which insurance choices people would make if this menu option was not available, and then to predict what the claims distribution given their risk values would look like. And so when we compare the welfare, we take our status quo model with the status quo option that everyone makes, and we compare this against this counterfactual model in which there's no monitoring available. And we can sum up the amount of money that consumers spend, the amount of profit that the firm makes, and the amount of profit that the competitor firms would make because consumers would switch to them under our model in this counterfactual world. And if we take the difference, what we find is that the monitoring program does create a decent amount of surplus for everyone, but it's broken up in a couple of different ways. So about I think $12 or $13 is just consumer surplus. That is to say that consumers save about $13 from the existence of the monitoring program. Then the firm makes an additional $9 or so. Now, other firms lose money because the monitoring program gives the monitoring firm a competitive advantage. And so we have to subtract that, that's in red. And then when we sum it all up, sorry, I think the consumer surplus was more like $11. When we sum it all up, we get a total surplus of green plus green minus red of about $13. So all in all, this is perhaps not a huge amount of money, but it is substantial. Monitoring does seem to be providing an overall benefit for everybody. But of course, I should mention that this is holding the unmonitored prices fixed. So this is not allowing the firm to change the prices that it would offer if monitoring was not available. And so to say something more about that, we have to go a little bit further, so I'll come back to it. But it's worth mentioning that even the welfare effect that we find, a lot of this is coming from the effect of monitoring itself. So if you remember, I mentioned that monitoring makes people about 30% better during their first period. Well, if we extrapolate that, that seems to be accounting for really most of the surplus. To see this, we can do another counterfactual in which we mimic everything in the process. We have our monitoring system exactly as is, where we just take out that impact. We don't allow people's risk parameters to change based on monitoring. And when we do that, we find that there's still some surplus to be had, but it's much lower. Only about 64% of the surplus goes away once you take out the incentive effect itself. All of which is to say the monitoring program seems to be doing a lot of work during monitoring. And you might wonder what would happen if monitoring lasted longer. Okay.
And by the way, just quickly, why couldn't they just say you're always going to be monitored? What's the problem with just doing that?
Let's leave that for the end. Okay. I think that might change. I think the short answer is that this is an evolving product, and they might go closer to that. But there are questions to what extent the company believes that continuous monitoring is true, and that's a function of corporate experimentation and maybe the value of having economists on board. Okay. So the last thing that I want to talk about, I hope that I've convinced you that monitoring itself seems to be providing some social value. But if monitoring is providing a social value, a natural question to ask is why we shouldn't have monitoring be available for everyone. Surely we can generate some more consumer surplus. As regulators, we typically care about maximizing consumer surplus. And so couldn't we increase it further by having not only the monitoring incentive effect, but then also having better prices from competition? And so to see what this world might look like, we consider a counterfactual in which we allow firm pricing to adjust. And we're also going to allow the other firms' prices to adjust. Now, insurance pricing is really, really complicated. And so we're going to simplify things for ourselves a little bit, and we're only going to adjust two parameters. We're going to take the baseline prices for premiums for every coverage and deductible level as they are, and we're going to let the firm scale the initial discount or surcharge for the initial discount or surcharge for the monitored and unmonitored pool, and the change in the final premium, which we would call the amount of risk sharing, rent sharing for the ultimate price that monitored drivers get. So just to say this again a little bit more concisely, the insurance company has two types of prices that it gives that it's going to adjust. One is the initial discount or surcharge that it offers people once they enter the market and decide whether they want to be monitored. The second is the premium that they get, the final premium that is discounted or surcharged that they get after they're monitored and after the insurance company learns what their type is. We're going to let the company adjust both these parameters. If it increases the discount initially for the monitored pool, or it increases the surcharge for the unmonitored pool, that would give more incentive for consumers to join monitoring, because it makes not being monitored more expensive, and conversely being monitored cheaper. But then the extent to which it increases or decreases the rent sharing, once people have already been monitored, will allow it to harvest more of the value of the monitored drivers. Okay, and so we're going to do two kinds of counterfactuals. The first counterfactual is just going to compute the optimal pricing. All the pricing that we've looked at so far, we held fixed, and we just took these are the pricing formulas that the firm came up with on its own. But since we have this rich model of demand and claims, we might ask, what is the optimal level of pricing given this framework? And we can compare that against the prices that we see. The second counterfactual that we're going to do is going to consider what would happen if there was a regulation that eliminated the ability for the company to hold the data as proprietary. So suppose that the company had to share whatever it learned about all monitored drivers with its competitors, what would happen? So let me briefly show you the results. So just looking at optimal pricing, given everything that we see, the biggest, maybe most striking thing for me is that the optimal surcharge for the unmonitored drivers is really not very large. So currently there's no surcharge at all. But even if the company were able to do whatever it wanted and was trying to maximize profits, it would only increase the surcharge by 2.7%. And Peter, you asked me initially how we got into this project. Well, this was the initial question I wanted to know. I wanted to know how much did people suffer from choosing to be in the unmonitored pool. And what this is showing is that even with optimal pricing, there's so much competition in the market that the insurance company just can't do very much, can't really punish people for not entering monitoring. So then how does it get people to join monitoring? Well, we find that under the optimal regime, the opt-in discount would increase dramatically to 22% on average. You can think about this as investing in trying to get more people to join the monitoring program so that you would learn much more about them, you would make them much better. This would, under our estimates, increase the total monitoring market share by almost 50%. And then in order to justify, in order to harvest some of this value that the insurance company paid so much to get, it would then reduce the rent sharing and basically give people lower discounts once they were monitored and found out to be good. But what would happen if you forced companies to share that information? Well, as soon as the company has to share the monitoring data, its ability to do rent sharing decreases a lot, because now it has a super competitive environment for the drivers that everybody now knows are much better. And without the ability to do a lot of rent sharing, the optimal opt-in discount decreases a lot. And so what do we find? Basically, we find that the ability for the company to retain the data as proprietary is what rationalizes the investment, the upfront cost that it needs to pay in order to get people to join monitoring. And so if we think that monitoring itself is a socially valuable thing, we can't just willy-nilly get rid of it because it's expensive. It's hard to get people to join. And so just to conclude, since I have just a minute left, this was a very big study of what I think is a very important topic. But we find in brief that monitoring and incentivized driving has a major effect. Drivers respond to financial incentives and do better when they have a good reason to. But there's very strong advantageous selection. This is not just an incentive effect, but actually people have a lot of information about whether they're good drivers or not. And so if you allow them to show you that in an incentivized way, they will. There are frictions, but the frictions are small relative to the magnitude of the number of people who join this program. And the company might have an incentive to try to get more and more people to join, but that incentive is very bounded by regulation and its ability to keep that data as proprietary. And so we should be careful in trying to regulate this. But of course, there are a lot of things to weigh. Thanks. I'm happy to stick around and answer questions, of course.
That's really wonderful. Thank you so much. So anybody who needs to go has my permission, not that they need it, to leave. But if Shoshana's going to stick around for a little bit, I'll just take you, raise your hand, and I will call on you. I know Bernie had a comment, so go ahead, Bernie. Why don't you start us off?
Yeah, thanks. So the conclusion is that the company suffers. The company suffers if their monitoring data is made public. I guess my question is, what about how would you do that evaluation if you were assessing all consumers or the entire market's welfare? We have situations, for example, where companies share claims data with one another, and that benefits the companies and it benefits consumers in that consumers don't have to sort of recreate their data from one company to the next, and it also allows companies to have ready access to information that's valuable for rating.
Yeah, absolutely. So competition, we typically think of, even though competition in information markets is a little bit more tricky, we typically think of competition as being good for consumers. The mechanism here that makes it a little bit different from claims is that claims have to be recorded anyway. They already exist, and so you're not producing any new information. The thing that's different about monitoring is that it is producing things that didn't exist before, both in terms of information and maybe in incentivized behavior. Maybe they're even teaching people to be better. And so if you think that that's valuable, which our model suggests it is valuable, it increases consumer surplus and it decreases claims. You might not want to eliminate it or decrease it. And so what the proprietary data does, or at least what our model is showing, is that the company needs to have some incentive in order to be willing to incentivize drivers to do this socially beneficial thing. So we can imagine another world, for example, maybe in which everyone is forced to have a monitoring device. And in that world, I think your intuition would be right. But if you can't force people in, then you need to incentivize them. And the question is, who's paying for that? If only one company is paying for it, then it's not clear, or rather, what our model would suggest is that it's probably not the case that if one company is paying for it, you can increase everybody's surplus by forcing them to then share it and not be able to reap the benefits.
Well, yeah, I guess I would have probably some disagreement with that, because I think there's a lot of examples of insurance where companies contribute to a database, a contributory database, which maximizes value for consumers and companies. I think the scenario you lay out is heavily biased towards the largest companies. If you're a big company, you've got a lot of data. So it creates even sort of less competition, because small and medium-sized companies simply don't have access to that. That's the whole concept of a contributory database.
Absolutely. It certainly reduces competition, and it certainly hurts other companies' profits, and ultimately probably increases consumers' prices relative to what they got if they were monitored. The only question, and I'm not disagreeing with you that this is I'm not saying this is definitely bad. I'm saying that it's not clear that in a world where the monitoring data had to be shared, that we would have as much monitoring, because the discounts would be lower. Now you might say, maybe that's fine. Maybe we're willing to have less because monitoring is cheap enough or common enough that we can get people to opt in anyway. But our model is suggesting that one should at least be a bit cautious.
So I had two quick questions. The first goes to sort of what Bernie was just talking about. You're talking about proprietary, but if I'm a consumer, don't I have my bill with my rating on it, or at least my premium on it, and I can just Xerox that and say to another insurance company, well, here's what they were charging me. And if the model is right, they should be incorporating all the available information from their monitoring into my premium. So that really tells the other insurance company all that they need to know. So that's question one. Question two, your welfare calculations don't say anything about the people that weren't injured because of the safer driving that I'm now doing because of the monitoring. So that seems like another plus that you could throw in there. Not that it's not complicated enough already, but you should maybe at least give yourself credit for that too.
Yeah, thank you. So to the first question, yeah, we can't. I don't know to what extent you can credibly convince another company that you are a better driver by showing them your bill. Certainly, you can to some degree, but what the company would get is this like very obfuscated number, and they don't know what you're being compared against, and they might not be able to back it out. I think, at least from my conversations with the company, that is what they said. They said that it's pretty hard to use just this number and to know what it means and to know how to interpret it. So that should limit it, but certainly you can do some things. And yeah, of course, there are other consequences, but we only see claims dollars, and so we report what we're able to be confident about.
From a consumer perspective, I'd like to be able to take my data from one company to another if I want to shop around for a better rate. And so one of the one of the frictions that you talk about, one of the reasons people may not want to get into a monitoring program is that they don't want to have to be monitored twice, or they don't want to have to be monitored again by the second company and the third company and the fourth company. They want to be able to take their data with them. And there may also be friction because they don't trust that the company will actually protect their data. And then the third friction might be that these are data I created. Why do I own my data? Why does the company own it? Just because they collect it.
Yeah, absolutely. Those are all good questions, and they're not just questions for insurance, right? Why we should own consumer data, I think, is a much broader, broader topic that's very complicated, and one that I've worked on in other projects as well. The only comment I want to add, other than to say that I generally agree that you're making very good points, is that consumers may also not want to have their data from one company shared with other companies. And so insofar as we know that there are frictions, those frictions might be higher if that data were shared more broadly as well. I'm not saying that they would be, I don't know, but it's not it's not obvious to me.
One of the big issues is, the outside of telematics is the type, the quality and the type of data that is being used for risk classification. Do you know, for the company you looked at, or companies generally, if they're doing this, are they using credit scores and other information as well to underwrite, or is the large majority of the underwriting they're doing for the individual consumer based on this information, the driving information?
I'm not 100% sure what I'm allowed to disclose, and so I'm going to be very cautious in answering this question.
Sure.
I think in general, credit information is something that's gettable, and at least in some places priceable, I think. I'm pretty sure. I think insurance companies get a lot of information outside of your driving information for sure. So outside of your traffic tickets, which they see, outside of your previous claims history, which they see, they often ask you, for example, about your level of education and your income, and they use all of that information, and it's very important in their pricing schemes. They also have lots of other ways to elicit information. So, for example, they might ask you if you're on the honor roll. They might ask you if you're in a specific program, if you're part of the ROTC. All of these things are very informative.
Thanks.
Yeah, but they are processed through a risk model, right? And so the insurance company will take all of the observable information that it's allowed to price on, build a statistical model based on the claims that they see. And the more data they have, the better they can do this, of course.
Okay, thank you.
Okay, well, it's looking like, I mean, I'd be delighted to spend another hour, but I'm sure you have other things to do, and it looks like there's no more questions. So I hope you'll just join me in thanking Shoshana for showing up, and really great paper and a great talk. Thank you.
Thank you very much.
Bye.
Thank you.